So let's get across to Taimur Baig. He's MD and Chief Economist Asia at Deutsche Bank. It's as good a voice as it can get for a viewer. Taimur, good morning. Thanks so much for joining in. As always, much appreciate having you. Your first thoughts, Taimur, on the Fed statement. The action was as per script, the statement of three. What do you make of it?
Oh, I think that there's quite a bit to take away from this one. I mean, after a long, long time, we're seeing the market and the Fed meeting in the same point, in the sense that you have the Fed looking at about 3 hikes next year. The market is assigning maybe slightly more than 50% probability to that. If you look at the last few years, the Fed has consistently been far more hawkish than the market, and eventually the market has won by pushing the Fed dots down to what the market was suggesting. This is one of those rare occasions where the market's buoyancy is now converging with the Fed, which was sounding rather downbeat just 6 months ago, but now is looking more and more comfortable with the employment, inflation, and overall economic outlook. So a truce between the market and the Fed, but this of course means for us here sitting in Asia, dollar strength and curve steepening to continue, which is not exactly good news for us.
Jahangir, good morning to you as well, and thank you for joining us. Now, Jahangir, do you think the messaging from the Fed is very simple and straightforward, which is that US economy is not booming, but it is clearly blossoming, and better days are coming?
I wouldn't say that, the better days are coming, but in terms of, higher growth, etc., even though the Fed does have a 2.1% growth rate, we are looking at about 1.9. Obviously, it is unclear how much fiscal deficit expansion the Fed has in that 2.1, but I think the point where the Fed seems to have moved towards is that, the labor market data that came out over the last few months suggesting a pretty sharp slowdown, sharp decline in the unemployment rate. They have taken that data to mean that output gaps are probably closing faster than earlier anticipated, and whether or not you get higher growth or not with higher fiscal deficit, the labor market tightening has begun, and you could actually see that the tightening in the labor market, not so much on wages, but definitely in unit labor costs and other such measures. So I think the Fed was reacting to the tightness in the labor market, and that probably is the core reason as to why the Fed went through its rate hike, and probably the reason as to why the median dots have now moved to 3 rather from 2 from what we had earlier.
What does this mean for, actually going ahead with those indicated 3 hikes? Because last year, same time, they'd indicated, roughly about 4 hikes, and they couldn't follow through on that. Do you think the environment right now is very different in anticipation of, like we're calling it, Trumponomics playing in, plus, the upside risks for inflation also being a matter of concern?
So we still continue to believe that the Fed will deliver 2 hikes. Probably it's a matter of how much of fiscal expansion the Fed has implied in its 2.1% growth rate. We are at 1.9. We don't think that the fiscal expansion, even if it does happen, will impact 2017 growth as much, maybe in 2018. But we are much more conservative on how much fiscal expansion can take place and how much that can affect the growth rate of the U.S. economy. One needs to keep in mind, and this is where I think a lot of the debate gets lost, that this is the economy in its 6th year of its expansion. If you look at indicators that are generally used to look at what's the probability of the economy slowing down or going into a recession probabilities 2 years ahead have actually risen and risen very sharply. So this is an economy that's already matured. In a matured economy, how much fiscal space expansion do you have, and how much fiscal induced growth you can deliver is not an easy question to answer, simply because if you look at the slack in the economy is significantly less. I think that, even though we continue to believe that there is only two more hikes in 2017.
Okay. Now, Taimur, let me get you on a question with regards to what this would do to flows as well. It could be two, it could be three. My question is, with the positioning that the Fed has given right now, which is of three for now, we've seen November being a month of strong outflows from emerging markets into DMs and arguably US as well. Do you think that trend continues? Because I did hear you mention in your opening statement that this would mean a stronger dollar, and even that would probably result in more outflows.
Right. So I think I need to sort of reinforce the one point that Jahangir was making in his talk as well, which is how much necessity there is for a fiscal stimulus, which of course the new administration seems very keen to implement. And if there is indeed the notion that the economy is at a very mature part of the cycle, any further stimulus measures that one does in the near term could lead to inflationary outcomes and also could be bad for the debt market. Well, that is all feeding into the narrative that we have seen over the last month. It just reinforces that, which is the strong dollar and higher rates narrative. Now, the question is the boomerang effect. I mean, I alluded earlier to the issue that it's bad news for us here in EM. But mind you, EM matters a lot for the US. So it will boomerang back if it hurts the EM economy substantially going into next year, if there are mini currency crises here and there, demand getting hurt because of the higher rates, then U.S. companies, which earn a very large chunk of their earnings from emerging market activities, will also see pressure on their economies, on their balance sheet. So that boomerang effect then starts shaving off growth from the U.S. So the strong dollar, steeper curve narrative first hurts EM, then boomerangs back to the US, which can create quite a bit of room for volatility. And therefore, I would be not particularly excited about the equity market outlook, whether it's in EM or DM going into 2017. And you could also argue that the Fed's somewhat hawkish tilt makes Mr. Trump's life a little difficult, because the strong dollar is basically the antithesis of what he wants to engineer, which is some sort of an export-based recovery out of the U.S. But the strong dollar sort of negates any of the tariff measures that the U.S. administration is now alluding to against their key trading partners.
No, that indeed is the case. In fact, we saw that at the beginning of 2014 as well, when yields went up sharply. And also at the beginning of last year, when the dollar index picked up, it really makes world markets nervous. But Taimur, just a quick word in, do you think the impact on emerging markets would be short-lived? Because now people are drawing that comparison between how with the U.S. economy doing well, or that's the expectation, it's going to be a rising tide lifting all boats. And so, yes, short-term emerging markets may be a bit impacted, but they'll come back maybe in 2018. Do you see that to be the trend, or do you think this time is different than the earlier bull run? Because, the earlier bull run was deriving its strength from globalization and global trade, which has been weaker now. And there's a lot more protectionist sort of measures coming in to help spur domestic consumption-led growth for economies. So it's very individual.
Yeah, so I think spot on that the idiosyncratic stories are probably far more dominant than across the EM theme that can manifest through 2017, 2018. Look, at the end of the day, strong commodities will be good for a key set of EM economies which have been doing very poorly lately. So the Russias, Brazils, South Africas of the world would do well. And here in Asia as well, you can think of Australia, Indonesia, Malaysia getting some sort of a lifeline. And beyond that, even if you think about a country like India, where the commodity sector has been under a great deal of pressure, higher commodity prices will be helpful on the margin. Let's put aside the inflation story that complicates the picture. But just in terms of stronger commodities helping the bottom line of oil refineries, miners, and so on, the answer is yes. But to what extent can we see a strong dollar and strong commodities? Because that's not a historical stylized fact. Normally, strong dollar tends to weaken commodities, but the last 1 month, due to the OPEC-related developments, we have seen that correlation break down, if you will, that they're actually now positively correlated when they normally should be negatively correlated. I personally remain fairly bearish about commodity demand in the near and medium term, and I also don't think that China, through its stockpiling, the way it has been supporting commodities the last year or so, will continue to do so in a very meaningful manner going forward. forward. So even though the supply side, due to the OPEC plus Russia accord, seems to suggest some bullishness about commodities for the time being, I don't think there's a whole lot of upside left. Whatever upside that we should have had, we've had already, and that helps EM on the margin, the commodity exporters, but not major dividend out of that in my view.
Jahangir, let me get closing comments from you. Now, the most crowded trade in the world is central bankers will print money, bond yields will remain low, and one should chase yields. So at a time when cost of capital, Jahangir, is likely to move up, at least in 2017 at a global level, do you think a lot of these cozy correlations will start breaking down?
I think that has already happened. I think if you look at the dominant trade position right now, it was a long US dollar wherever you can find it. And I think the fact that the Fed not only raised rates, but also moved the dots up from 2 to 3 actually justifies that positioning. Because if the Fed had just moved and not moved the dots, I think you would have seen today quite a bit of the long dollar positions being taken out. So I think the long dollar positions are already there. And I think those cozy relations obviously are getting pushed back. You have the ECB that has brought forward the end of its QE. Japan is the only country that's left, but Japan also had moved away from actually massive amounts of QE to basically targeting its 10-year yields, which may or may not, depending upon that month's flow, add how much it would add to the actual liquidity position. So I think that liquidity expansion story is slowly coming to an end, and I think that the market is positioning for it, and I think other than that, I would just add to Taimur's point about yields continuing to rise. I think apart from the fact that it affects capital flows, what it also does is that the space that emerging market central bankers have, and I will leave India out of it for the moment. The space that emerging market central bankers had to add to easing in the face of slowing growth, I think that space also gets taken out. So at least for the first half of the year, it is very difficult to see small, open, emerging market economies adding to any kind of monetary easing. And as we've seen, a couple of weeks back, countries like Turkey have already started to hike rates. So I think the yield going up story, which Taimur talked about, I think that is a real story, and that story not only affects capital flows, but I think in a very real manner, it constrains emerging market central bankers to provide support.
Very, very pertinent points. Thanks very much, Jahangir, as well as Taimur, for joining us this morning.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.